Hello and welcome to our latest Insider interview. Today in the studio I have with me Samantha Fitzpatrick, Fund Manager of the Murray International Investment Trust. Samantha, thanks for coming in today.
Pleasure.
So Samantha, both yourself and Martin Conahan will be taking over as Fund Managers of Murray International from June 2024, following the retirement of Bruce Stout. Will it be business as usual in terms of the investment approach and the aims of the strategy?
Absolutely. So we have both worked with Bruce for a long time. For over 20 years we've been part of the same global equities team, and we have both been formally involved in the management of Murray International for several years now. So I first attended my board meeting, for example, at the end of 2019. I've been attending board meetings, meeting shareholders, doing this sort of thing since that time, and Martin was actually a couple of years before me. And the idea behind that was for Bruce's eventual retirement. Nobody knew at that point what the time frame would be, but it made a lot of sense to prepare for that well in advance, to get people used to new faces, new voices, and also having two people in charge rather than just the fund being associated with one name seems to be the way the industry's going, and I think it makes a lot of sense. So as I say, we've been working together for many years. We are well versed in what Murray International is and what it will continue to be going forward, and we're very proud to be associated with the trust.
In terms of geographical exposure, the thing that stands out is that Murray International has a lot more in emerging markets, Asia Pacific and Latin America than other global equity income funds and investment trusts. Within that area of the world, are there certain themes that the trust is trying to profit from?
There's the obvious themes of a better backdrop for some markets in terms of demographics, urbanisation. All these big themes act as a tailwind rather than a headwind for some of these markets. But to be honest with you, for any investment to make it into Murray International, it's got to be there on its own merits, whether that be listed in Brazil or listed in Singapore or listed in the UK. So it always comes through the companies themselves rather than trying to think of a theme and then fix some way of playing that theme. And what we find quite strange is that Asia and emerging markets are often lumped together, and that is just really strange because there's really very little in common if you look at some of the underlying investments in Asia and emerging markets. So OCBC, which is a Singaporean bank, for example, has really nothing in common with China Resources Land, a logistics company in China, nothing really to do with a lithium producer in Chile. So I understand why people look at big categories and sometimes maybe make judgments or want to question these things, but for us, each of the 50 names in the trust, roughly 50 holdings at present, they're all different. They're all there absolutely because we believe in them as companies, and the backdrop for some markets, as I say, can give you that extra edge.
And within those 50 companies, are there certain qualities or characteristics that you're looking for? Yeah,
absolutely. So one thing we would always look at is the debt profile of a business, because if a company is very highly indebted, it's therefore not got the same room for manoeuvre if circumstances change, if it has to come to the market for more funding, for example. So we do absolutely look at balance sheets, we look at cash flows. We want companies that are hopefully going to be resilient in difficult times. So that's really, really important no matter where the company's listed or what it does actually. We always look for management teams that we can trust. It sounds really simple, really basic and obvious, but you have to believe that the people in charge are looking after shareholders' best interests, and you can look at track records, you can see what's happened in the past. And obviously companies that are in industries that we can understand and can value, and that actually is not always a given, so we have to come at it for each and every investment with that approach.
Murray International has a dividend yield of around 4.5%, which is higher than most other global equity income funds and global equity income investment trusts. So how do you strike the right balance between delivering dividends and capital growth?
Yeah, that's a really good question, because it's got to be both. You know, we want to grow income and we want to grow capital in real terms, ideally. That's been tough over the last couple of years, given where inflation has been. And for each and every investment, you're looking for that stock or that bond to contribute in both, ideally. So we look at the income prospects and the capital prospects for every single potential investment we would look at. And now it's not the case that they've got to be scoring 10 out of 10 for each. Sometimes a position will be in there because we think it can deliver more on the income side at a particular point in time, or we think, you know what, the yield's quite low just now for our investments, but we think there's more capital upside and we think there's more to go for in future in terms of income growth. So that balance is not the same. It's not always 50-50, you know, between every investment, and it can change even with individual holdings. So we have a position in the trust, actually the largest position in Murray International just now, a US semiconductor company called Broadcom. And we introduced that in March 2020 when it yielded 7%. So that was really attractive at that point in time. We still liked the balance sheet, still liked the management team, still liked the overall prospects for the business, but that was more of a look at this yield, that's really, you know, attractive here. Fast forward to now, it's now yielding about 2% because the capital appreciation has been so strong over the past 12 months especially. So it's always a changing dynamic. And we would say that every single company has to contribute to that yield. So we wouldn't typically invest in a stock that's just there for capital and doesn't offer something in the yield front. They've all got to earn income in some capacity. But it's not just about looking at minimum yield, the growth and the potential and the capital upside is equally important.
Could you name a couple of the highest yielding stocks in the portfolio today?
Sure, it's interesting when you look at that and take a snapshot at any one particular point in time, because it might throw up names that you're not maybe thinking that would be there. The highest one, if you just look at Bloomberg today, is a Chilean lithium company. It produces other things as well, but lithium's the thing that's got the markets all excited, given its links to electric vehicle batteries. And it's yielding about 14% just now. Now that's a cyclical business. It had a very, very strong year last year on the capital front, and it also had loads of cash, so it was able to pay back to shareholders. That's not something that you would see is going to be repeated year after year after year, but that's currently the highest yielding stock. And some of the other more cyclical names in the trust have also got really high yields right here, right now. So some of the energy companies, materials companies, for example, would be in that category. Now that does change. Obviously, we're not expecting that to continue necessarily this year. There's other types of companies that do offer more reliability in that front. So that's why there is still a place for some of the consumer staples names. Tobacco companies, which can be quite controversial, but British American Tobacco, for example, has a very high yield compared to other companies, and it's there more for that reason and more for that consistency of income that delivers. So because we've got a British American Tobacco in there, we can afford to have something that's not as reliable, that's going to be more up and down on the income front. So it always is, there's more to it than just looking at, you know, a ranking of stocks to see this is a high yield, this is a low yield. It does change quite markedly over time.
You mentioned Broadcom. You've got two other semiconductor companies within your top 10 holdings. Why is it that you're finding that area so attractive?
Yeah, we do. Most of our tech exposure is involved in semiconductors, something that we're wary of actually, and we've been trying to think about how we could maybe spread that a bit better. But we're happy with the companies that we do have within semiconductors. Taiwan Semiconductor is the biggest producer in the world. We've got really quite nice exposure there, even in smaller market cap names as well. So one of the more recent introductions into the trust last year was a company called BE Semiconductor. It's a Dutch business, relatively small in the market cap size, unlike something like TSMC. It's about €10 billion market cap. And although it operates within semiconductors, it doesn't do exactly the same things. So it's more involved in the actual piecing together of the chips and doing that more efficiently. And it sells machines to the likes of TSMC. So it's not necessarily replicating the same thing. And certainly the long-term demand for these things is just not going away anytime soon. You know, you think of everything that you have in your life that's you need to plug in, you know, it's electronic, and that's only going one way. So we're happy to, if you talk about themes, that's a theme certainly in the trust that we think We're happy to have exposure to, again, it's cyclical, so you have to be mindful of that. It's not always going to be, going one way, plain sailing. But I think in terms of the long-term potential for these companies, it's looking pretty promising right now still.
Mentioned a holding that you bought there last year. Yeah. For the portfolio this year, has there been many changes made at all since the start of 2023?
Yeah, you would look at our half-year report and think, what have you been doing? Like, we've not done a lot in terms of the first 6 months of the year. A couple of sales, no purchases, but since then, since the end of June to this point in time, there has been a bit more activity on both sides. So one stock we have introduced recently is Walmart de Mexico. So this is the company which is associated with the US parent Walmart. And we were interested in this business for a few reasons. So unlike the developed world, like the UK, food retail and other types of retail in parts of emerging markets is positioned very differently. So it's actually quite an attractive place to be in terms of the margins it generates, the dominance that some of these companies have, and just in terms of general incomes rising, that potential for increased sales is very, very different from what we're used to here in the UK. Walmart de Mexico has no debt, so it has great control in that sense. And it can tap into its parent for things like purchasing and just general know-how about how to run this kind of business. So we like that. And one thing that prompted us to do the trade right here, right now, is the situation in Mexico with regards to inflation. So inflation had been ramping up very, very high, and Walmart de Mexico took that on the chin a lot of the time. It didn't pass it all through to its customer base, it sat back. But because of that, it hasn't lost customers. Those customers are still there, still shopping with them. And now, as inflation has come back down again, they will certainly benefit on the other side from their costs coming down. So we think that it's an attractive business. It's looking pretty reasonable in valuation. It also contributes to the dividend yield that we're trying to achieve as well. And we funded that actually partly from selling out of another Mexican holding, Kimberly-Clark de Mexico, which produces a lot of nappies and tissues and things like that in Mexico, and this has performed so well. It's really defied all expectations in terms of getting not only pricing increases but volume increases, and that's where a lot of the consumer staples companies have struggled. They've all increased prices, but as people feel the pinch, they pull back on just how much they spend in terms of volume. It's managed to achieve both. But it doesn't owe us a thing. Now up here, it's performed so well that we thought recycling that money into, in some ways, a similar business, but we think right here, right now, with more potential going forward, makes sense.
And finally, a question we ask all fund managers we interview: do you have skin in the game?
I do, yes, and so does Martin, so does Bruce. If you ask them the question, you would get the same answer. This is a strategy I absolutely believe in. I think hopefully that comes across when people hear us talk. We are really committed to this way of managing money and this long-term approach to investing. The three of us only ever managed money this way, so we've not kind of flipped in and out of different types of strategies. So I'm very happy to be a shareholder also.
Samantha, thank you for your time today.
Thank you very much.
So that's it for this episode of our Insider Interview series. You can check out the rest of the series on our YouTube channel. You can like, subscribe and comment, and hopefully I'll see you again next time.